Now here, I've included power pivots. They've been around a long time and originally used by floor traders. It was a nice, simple way for floor traders to have some idea of where the market was heading during the course of the day. It's a very interesting strategy which I hope you too find it of interest. The pivot point is the level at which the market direction changes for the day. Using some simple arithmetic and the previous day's high, low, close, a series of points are derived. These points can be critical support and resistance levels. These collectively are called pivot levels and are updated daily. The reason pivot points are so popular is that they are predictive as opposed to lagging. You use the information of the previous day to calculate potential turning points for the day you are about to trade. These values are used by institutional and experienced traders to help them determine whether there is a bearish or bullish bias. Because so many traders follow pivot points, you will often find that the market reacts at these levels. For example, if the power pivot was calculated at $2 yesterday and the share price opened at $1.95 today, we have a bearish outlook and would be looking at going short, but if then it passes through $2 to $2.10, this is seen to be bullish and the reverse applies. The three most important pivot points are R1 and S1 and the actual pivot point itself. The general idea behind the trading pivot points is to look for a reversal or a break of R1 or resistance 1 or S1, support 1. Let me show you an example of a trading day. The green line is the pivot point. Red lines represent support levels 1, 2 and 3 and blue lines represent resistance levels 1, 2 and 3. There are several ways to trade this day using pivot points, but I will cover 3, but encourage you to use other instruments for confirmation such as candlestick analysis, MACD or perhaps even moving average crossovers. At the beginning of the day, we were below the pivot point, so our bias is for short trades. A channel formed, so you would be looking for a breakout of the channel, preferably to the downside. In this type of trade, you would have your sell entry order just below the bottom channel line, with a stop buy order just above the upper channel line, with a target of S1. The problem on this day was that S1 was very close to the breakout level, and there wasn't really enough meat in the trade, 13 pips. This is a good entry technique, but unfortunately it was not as suitable as we would have liked this day. For intraday traders, please experiment for yourself. This is a very popular setup technique. The market passes through S1 and then pulls back. An entry order is placed below support, which here was the most recent low before the pullback. A stop is then placed above the pullback, the most recent high, or peak if you like, and a target set for S2. The problem again on this day was that the target of S2 was too close and the market never took out the previous support, which tells us that the market sentiment is beginning to change. As the day progressed, the market started heading back up to S1 and formed a channel congestion area. This is another good setup for a trade. An entry order is placed just above the channel line with a stop just below the lower channel line. And the first target would be the pivot line. As it happened, the market never stopped and your second target then became R1. This was also achieved. I would tighten my stop and exit the first opportunity when exit is triggered. If you would like a free trial of the JBL Risk Manager, a free 14-day free trial, simply enter JBL Risk Manager into Google or go to www.paconsulting.net.au. You've got nothing to lose and so much to gain. also available from Paratech Worldwide, and other resellers are also welcome. That's all for now. Any comments or suggestions are always welcomed. Thank you. And remember, plan your trade and trade your plan. I wish you all trading success. Thank you.